and put yourselves on mute. So basically, once we'll have first John do the introductions, then we'll have Pierre do his presentation, and then if I could ask you to rejoin with your videos and with the microphones.
Ready whenever you are.
Great. Perfect. John, over to you.
Good afternoon, good morning, everyone. Thank you for joining us for the launch of OMFIF's inaugural Global Public Pension Survey. I'm John Orchard, OMFIF's CEO, and Pierre Ortlieb, our senior economist who ran the report, will take you through its key findings in just a moment. And then OMFIF's chairman, David Marsh, will talk about the findings with two key investors, along with Citigroup, who together with Capital Group helped enable this important revealing piece of work. We've got an excellent audience on today from around the world and from all parts of the financial system. We've got central banks, asset managers of all types, trustees, stock exchanges, rating agencies, major development banks, commercial banks, and indeed public pensions. Thank you all very much for taking the time to join us today. We'd be delighted for you to put questions to our panel, so do please use the chat function on YouTube. I know that David will be keen to field your questions for the panel in a moment. There's an awful lot to talk about, but before we do, a quick word on context. OMFIF has run a survey for 7 years called GPI, or Global Public Investor, which looks at asset allocation decisions among reserve asset managers and sovereign wealth funds. Do look it up on omfif.org if you haven't seen it. We found a complicated mix this year of risk on and risk off thinking, including a shift to gold together with a move into alternative assets in the search for yield, which we'll also talk about here. This new flagship survey examines public pensions specifically, which in total have around $17 trillion in AUM. And in it, we're mapping out the allocations, returns and actuarial assumptions of 100 of the world's largest public pension funds, and including looking, as we do that, at key developments in stewardship, demographics, and operations management. Needless to say, these institutions have quite a difficult job to do to make the appropriate return with the instruments they used to rely on in the past, for reasons you all understand, such as government bonds yielding nothing or less than nothing. Pierre will explain where they are going to try to solve that problem in a moment. Public institutions also have growing ESG responsibilities. We'll look at that too, and the extent to which that is aligned with the financial objectives. It remains for me to thank you for listening in today. Do please send us your questions. As I said, David will be very happy to field them to our esteemed panelists. We've got some great speakers for you today. Thank you in particular to Citigroup and to Capital Group, who sponsored this key piece of research, and we really look forward to making it a time series for you. So with that, over to you, Pierre, to talk us through the initial findings.
Thank you, John. Let me just start sharing my screen here. I believe this should do it. I'm assuming that I'm in screen sharing mode now, so I'll get started and I'll keep it brief so that we can quickly move on to our stellar panel. So, as John mentioned, we've been looking at public pension funds in the context of our Global Public Investor Report for a couple of years. What stands out really is that public pension funds are by far the largest institution group among the three types that we look at. So as you can see here, they hold just over $17 trillion in assets as of the 2020 GPI. So that makes them, twice as large as sovereign wealth funds, and significantly more interesting and larger than central banks as investors. And so just to kind of sketch the landscape a little bit more, the last year's GPI sort of demonstrated that the geographic location of public pension assets is quite skewed in its distribution. So as you can see over here in figure 2, most, or at least a sizable chunk of public pension fund assets are concentrated in the US and then in Canada, with Japan at second place. Obviously GPIF as a gigantic public fund, it makes up the bulk of that. And then you have other sort of classic pensions markets like the Netherlands, South Korea, Sweden, and the UK. So just to introduce the findings of our data aggregation exercise a little bit more, we have a chapter in the publication that looks at demographics with a great contribution from Torbjörn, who's speaking on the panel today, featured in there as well. And so, you know, this pair of challenges that I want to highlight, the first one is demographics. And what you see here is basically that the balance between inflows and outflows has become rather unfavorable, with retirees living much longer and fertility rates declining across developed economies. While at the same time, the other side of that coin is that investment returns have declined precipitously over the past sort of 10, 20 years, broadly speaking. So as you can see on the left-hand side, government bonds, once sort of the meat and potatoes, if you will, of a public pension fund portfolio, yield, you know, very little compared to at the turn of the millennium. On the right-hand side, you see kind of the returns across some major asset classes like, you know, U.S. equities, real estate, and you'll see that there's very little in sort of traditional fixed income assets like corporate or government bonds to be gleaned in terms of returns. So these two trends, they kind of crystallize in the first finding from our data exercise that I want to highlight, and that has to do with actuarial assumptions. So one thing that we decided to do, we took a sample of 100 public pension funds and aggregated where we could, where it was made available, their long-term real investment return target, and in the US case, and also where else available, a nominal or discount rate that's often used. And we wanted to kind of slice those in a number of different ways. So as you can see on the left-hand side, you have sort of a small time series of average long-term real investment return assumptions across a number of jurisdictions. So as you can see, quite high in the US, whereas other you know, the average across other countries has declined a little bit as returns have faded. So you can see a decline in Denmark and the UK between 2015 and 2019. So these assumptions are important because they're a projection of how the asset pool is going to develop. And if the assumption is set too high and sort of realized returns continuously fail to meet the target, then that will place a greater burden on contributors in the future. So the idea is to achieve some kind of balance of you know, intergenerational equity, if you will, for lack of a better term. So it's really about balance. And right now, the real long-term targets are still quite high. So for me personally, I mean, I suppose it's for us to discuss in the panel, but it's not clear to me how public pensions aim to achieve those returns. On the right-hand side, for the US specifically, what's interesting here, and I wanted to highlight this, is that so the average nominal rate that's used by the public pension funds in our sample has declined slightly over the course of the period covered here. But the average real target rate has stayed roughly constant. So in the US, as many of you will know, the discount rate is made up of a real return target and an inflation assumption. So what we see here among the sample, being the caveat, is that it's actually the inflation assumptions that have changed more than real return assumptions. So with that sort of mention of returns and how to achieve them, I'll run to the second point, which is where we took this sample of 100 allocations that I mentioned, and we kind of tried to glean what the average portfolio looks like. So as you can see on the left-hand side, fixed income at 43.2% is still a quite sizable share, but I think lower than you know, historical norm. Whereas the public equity share is at a third, is quite large, and you have another 13%. That's this gray and pale green section in real assets and private equity. We have an other share here in purple that includes mostly cash, I would say, in most cases, but also some of the other alternative investments that are a little bit harder to classify, like credit risk sharing or hedge funds. So refining these categories is obviously something that we can work on in the future. But so this shows kind of the average cross-country public pension portfolio across the 100 funds we've aggregated. These are all as a share of total assets. So with that, I'd want to point out that there are significant, you know, sort of regional idiosyncrasies. On the left-hand side, you see the so-called Canadian model illustrated by our figures. So in among Canadian funds in the sample, there's a much higher allocation to real assets and private equity, which is presumably to be expected. And then on the right-hand side, you see that, in another case, Australian funds are sort of more tilted towards listed equities. So this is broken down by in different ways within the report. It's sliced by country, by AUM, by several different ways. So I point you toward the report for more on this on the data set. Finally, we also have a chapter on private equity, where we kind of look more closely at how private equity has been driving portfolios over the sort of past decade, how they've been leveraged to achieve sustainability objectives. And as you can see, again, Canada, the UK, and the US clearly dominate the sort of private equity league table, if you will. And one reason why that might be the case is that in the US specifically, returns on private equity assets tend to generally outperform the global average. That's what you see here in Figure 14. And then on a final point, I mean, I showed you a few slides ago these sort of relatively large listed equity slice, and these greater holdings by a sort of increasingly socially responsible set of asset owners, that sort of has allowed us, has allowed asset owners, asset managers to develop a kind of a more holistic conception of responsibility. And that's the last thing that I want to highlight. We have a chapter where we focus on shareholder activism by public pension funds in the corporate governance space. So as you can see here, we try to map out activity in that sector. And as you can see, there's quite a steep decline after, at the turn of the past decade, the start of the 2010s after the financial crisis. But my sense is that given this kind of this new sense of stewardship that we're seeing in a lot of among a lot of asset owners and asset managers, I wonder whether we could see an uptick in precisely these figures over the coming years. And just on the right-hand side here, I mean, GPIF, as many of you know, will have been very much at the forefront of a lot of thinking on stewardship, especially at the start of this year. You may have seen some coverage of it. And so we have a great piece by them in the publication as well as several other public pension funds across the report. So I'd encourage you to take a look at it. I'm very proud of our work on this. As a final point, I'd note that we've taken kind of the data that we've aggregated and made it available online to scroll through. We have the 100 pension funds in the sample listed, as well as their total assets, a breakdown of each slice of each asset class as a share of total assets, and then a little mini time series on returns here as you just scroll over the figures. So that's it for me. I'm happy to take any questions by email, and with that, I'll pass over to the panel and to David.
Yes, thank you very much, Pierre. And please do stay on the line, Pierre, because I'm sure there will be some questions coming up and we can rope you into the panel as well in a virtual way. As John said, we would welcome any kind of questions or points from the audience. Please do send them in by the chat function. And I'm sure there'll be lots of issues where you can also help us improve this, because as John says, we want to try to do this on a yearly basis. And I hope very much we'll be able to do that. There'll be all kinds of data points that we're missing, areas where we can maybe do the coverage better, things that we haven't done effectively this time round, and we can improve that in future. So to take us through all these different findings and talk about what that means for their individual institution, I've got 4 stalwarts with me now to discuss this. I'm going to just introduce very briefly in the order in which they'll be speaking. First of all, Sally Bridgeland, who's the chair of the Local Pensions Partnership Investment from the UK. Secondly, Torbjörn Hanak, who's the head of the Strategic Asset Allocation at the Swedish AP Fonden 3. Thank you also, Torbjörn, for contributing a chapter on demographics for the GPP itself. Stefan Dunatov, who's Executive Vice President looking at investment and risk at the British Columbia Pension Fund, so all the way out in the west coast of Canada. Thank you for joining us. And then Sandy Call, who's from Citi, one of the institutions behind this report, Global Head of Business Advisory Services. So thank you for being on the line to talk about these individual aspects. Could I start with you, Sally, then? You've heard this issue about lowering the proportion that goes into the traditional area of fixed income and increasing the equity proportion. That's something I'm sure you would recognize. Also, this move into the area of so-called alternatives. About time we had a new word, I think, for alternatives, and I'm sure we'll come on to that in the future. You could tell us a little bit about that. Before that happens, there is a poll which I think will be appearing on your screens, and I can put this up, and people around the world who are listening to this can actually be answering this while Sally gets into her stride, because apparently it takes a couple of minutes for this to actually work. So just to give us an impression of how long we expect this relatively unusual period of low interest rates to continue, could you, those in the audience who are able to do this, could you simply tick on the box whether you think this period of low interest rates, non-normal interest rates would be 2, 4, 10 years, or will it just never get back to something we might call, in inverted commas, normal? So please be entering those into your forms on the screen in the next few minutes, and then no doubt the results will flash up and Sally will be able to comment on them. So Sally, first of all, from your vantage point, can you comment on what you heard from Pierre in the description so far? How does that apply to you? And can you give us a few pointers for the future, please? Sally.
Thanks very much, David. I hope you can see me. I can't see me, so do let me know if
I can see you, Sally. So you're coming across loud and clear.
Adjust my volume or adjust my camera. I think the results that are coming up are showing that 4 years is a long time in the world of politics, or 4 weeks is as well. I think the interesting thing to me about the report is that public funds around the world are subject to very different political needs and pressures, so the overall statistics reflect quite a dispersion and diversity of actually what different pension funds are doing. So if I think, I've been in pensions in the UK for 35 years, and the pressures from politicians have been around wanting to increase investment in innovation and venture capital, to local or national infrastructure projects. And at Local Pensions Partnership, we were set up as a pool for local authority pension funds, partly as a political imperative to pool investments, save costs and improve governance. So it's less about the returns and more about the costs and the efficiency of doing what we're doing. The current pressure in the UK is very much on climate change. So in law, private pension funds have to consider climate change as a financial matter. So it's part of their fiduciary responsibilities. And so most pension funds are grappling with how do they report against that? How do they articulate their desires on that? And that is driving a certain amount of thinking on different kinds of investments. And I think to your question about alternatives are quite often linked to illiquid investments or exclusive investments, things that need a bit more research, a bit more thinking about, and are always worth investing in for those public institutions that are thinking long term, but thinking beyond that short-term volatility and also beyond the current political whims to some zeitgeist which may endure. It's really quite a challenge. It's very important with the extra yield that you get from alternative investments, not to overpay, not overpaying for fashion and not overpaying for the risks that you're taking. And in particular, anticipating those externalities which are currently off the radar and aren't reflected in the price of investments, rather like climate change would have been 5 or 10 years ago. So if I had a crystal ball, or if I was thinking about the agenda, I'd say that a particular focus on infrastructure and the social impacts of COVID and the S part of ESG, the social part, are really something that need to be at the forefront when deciding how you're going to invest in the future. Thank you.
Yes, just before I go over to Torbjørn, on this whole question of ESG, it clearly has become rather fashionable in recent times. Do you tend to use your own set of parameters? Would you and the other funds which are associated with you tend to use a lot of outside benchmarks and basically rely on them? Do you have exclusion policies, for example, which are put into place across the field, or do you just basically decide on exclusion on a case-to-case basis? Because some funds have a very principles-orientated approach here, and some have a very prescriptive approach. Just wonder what areas you're leaning towards in the way, Sally, that you look towards this hot potato of ESG.
Yeah, so I think those who are trying to, if I'm mixing metaphors too much, tick a box with their hot potatoes are finding it quite difficult because the indices, the index providers have got very different definitions. So you have to think quite hard about what you really want to be doing rather than just assuming that there's an index out there that solves that problem. So being thoughtful about what matters to you is really important. The challenge for asset managers then is that their different clients may have thought about things in different ways. And these are things that different organizations, so I'm involved with other organizations, a couple of charities who've got very different views on particular exclusions and particular priorities, because one of them is an innovation charity. So they want to be pro-innovation in their ESG expressions. At the local pensions partnership, there are particular emphases that we have around avoiding thermal coal, but also we have to think about London because we invest the assets of the London Pension Fund Authority. So that particular regeneration, social housing, those issues are very much on our agenda. So it's partly about exclusions, but it's very much at the moment in the hot potato. Those who are thinking about the hot potato are thinking very much about what are the positive impacts that we want to be making, and how does our mission as an organisation push us in a different direction from others?
No, well, thank you. I'm sure that will be something we can elaborate upon. The poll that we've done does seem to show a suspiciously large number of people think that we're going to have these relatively low interest rates for about 10 years. So that's a bit of a rule of thumb that we can take here. I'm always suspicious of opinion polls. I tend to think that the opposite will happen. So that's something that we might then talk about in the course of this discussion. But we can probably now take that off the screen. We've heard what the audience thinks. Torbjørn, as well as telling us something about demographics, fascinating area that you discussed in the GPP report, can you also just comment upon this issue about how long will you have to be battling against this environment of very low interest rates?
No, that is of course tied to demographics, which is a very natural thing. I appreciated the feedback from the audience here, and almost a third expect rates to return to normal within 4 years. That must mean that normal is close to zero. And it might well be. The demographics will probably point in the direction of normal policy rates to be close to zero. And why do I say that? Well, first of all, we have been on this journey from high policy rates, I guess, to zero negative policy rates for the past 40 years. So it's been a journey. It's not been an event. It's been a trend, and the way I see that trend, or one way of understanding that trend, is certainly demographics, which basically say that the global population growth rate peaked in the late 60s, the early 70s, and since then has been on this downward trajectory as well. So at least it's a very coincidental development which have occurred over the past 30 to 40 years. I think, and what's the end game there? Well, if you look at demographics, it seems like the global population will peak around the year 2100. And if we are 7.5 billion people today, we expect to be 10 billion people around that time. And afterwards, the number of people will decline. That means that the underlying global growth rates in population will approach zero and eventually become negative. And it seems like economic growth is very closely related to that growth rate in the global population. The other part of economic growth, productivity, is actually very stable over time. It shifts around between regions and countries, but on a global scale, it seems to be very stable. My article that you highlighted points to a somewhat interesting development right now. We have been through something that you could call falling off a cliff in terms of growth rate of working age population, i.e. say people are between 15 and 64 in this example, declined rapidly. The growth rate in that part of the global population declined rapidly between roughly the year 2000 and 2015. And that's actually leveling off. And I'm starting to think that financial markets have adjusted to this quite well, like they should. They have seen this fall off of a cliff over the past 15 years, 20 years, and have adjusted to that in terms of level of interest rates primarily. And if we are now through the worst falling off the cliff phase and we're stabilizing at a very low growth rate, in many countries, a negative growth rates in the working age population, then maybe interest rates have reached their trough, or we have reached zero and we might stay there for a while.
You could look at these demographics in several different ways. There's a book which we've mentioned in the past by Charles Goodhart and Manoj Pradhan, which makes the point that inflation might actually rise as a result of a squeeze on manpower. You could also make the point that there's going to be actually an excess of labour, particularly people coming from developing countries to work in the advanced West through all sorts of immigration, whether forced or otherwise because of fighting wars or crises. You know, you can work it both ways. It could undermine this idea that interest rates are going to remain low for a long time because inflation may be on its way back. And I must admit, I tend towards that thought myself. Where do you stand on that, Torbjörn? Because that would actually mean that this compact we have with central banks, they're going to keep the interest rates very low for a long period of time to help financing governments. That compact may be broken. That would have a big impact. Where do you stand on that before we go on in the panel?
No, two observations. The first one, with fewer people coming to the labor market, and that might create an inflation pressure eventually. It will to some degree be balanced by robotics and automation. So many people would argue that robotics and automation will continue to be deflationary and create unemployment. But I think there's a decent balance there, to be honest. I think in the West, we will be scrambling to find doctors, nurses, and teachers for this decade. That we will be busy to find people doing those kind of very service-oriented jobs, which will be difficult to replace with robots immediately. So I think there's a decent balance there. There will be a shortage of labor. That's my main point. Eventually, robots will take over, or at least help. The other point, let's see what we were talking about. We were talking about inflation pressure, so eventually. I think right now central banks are very happy to let that happen. They are very happy to let the yield curve steepen. That will benefit the financial system and pension systems. So that's probably a pretty good bet that central banks will sit on their hand as inflation start to at least creep up a bit.
Well, we can intensify that a bit later, this discussion. Sandra Call, over to you now. I believe you think that these changes, particularly in the ESG area, the greater sensitivity, will have a big impact on the way investment products are structured and marketed. Can you tell us about how that's going to affect global public pension funds?
Yes, great. Thank you, David. And thank you for everyone for having us today. So we've been really exploring this issue of ESG and how it is expressed in investment portfolios. And we really expect to see, based on interviews that we've done with asset owners, asset managers, hedge funds, private equity firms all over the world, we really see us on the cusp of an important change in thinking and approach around ESG. First is that a lot of what is happening in the portfolios today is really based around this idea that we are managing the headline risk. You had asked earlier, is this because of principles or is this because of policies? But the whole approach towards exclusion, the whole approach towards integration of these blended ESG scores, what it's really resulting in is a very unclear linkage between the allocation of capital and the actual impacts on corporate behavior that that capital is helping to facilitate. There's a lot of uncertainty about what the ESG scores really represent for different companies because they tend to blend ideas around governance, around ideas around social issues and stances around environmental issues into a single score that can oftentimes allow excellence in one area to offset real issues for a company in a different area. And so what we expect to see over the coming few years, 2 to 3 years going forward, are three things. We expect to see better measurement of the specific risks that exist within the portfolio. And we think that the launch of the European Union disclosure rules in 2021 will really help to stimulate this shift, because there you're going to have to see both issuers and companies as well as investment managers begin to very specifically report around their activities' impact on climate change. And so you will start to really be able to understand the value at risk in your portfolios and be able to understand the actions being taken by specific companies around that aspect of ESG, not their blended ESG score, but their specific aspect on climate. And that's illustrative of where we think the whole trend is going. Thinking about ESG as a blended phenomena oftentimes masks some of the underlying change that needs to happen within the companies. And so we think we're going to be able to use the increased transparency that we're going to be getting from companies. We're going to be able to use the better framework for measuring materiality and the materiality of different risks within companies. That's coming out through new standards like the Sustainability Accounting Board standards from SASB. And we think that the products that people invest in are increasingly, instead of just integrating ESG as an overall risk factor, they will begin to really target the key performance indicators that will measure whether a company is reducing a risk in ESG, or as Sally had mentioned earlier, is actually creating a positive impact that you can point to in the portfolio as additionality. And so we see a big shift coming in the way that ESG investing is happening. And we think that the increased focus by asset owners and the increased perception that these pre-financial risks, these risks that emerge from the E, the S, or the G factors that have the potential to impact the financials in your portfolio, that they will increasingly, we will start to look to manage them, not just have headlines.
And Sandy, do you see the regulators or the authorities in all these cases, let's say in the EU, they will be the ones in the driving seat? Will it be the pension funds themselves who are taking this more rigorous attitude? Who's going to really have the upper hand in asking the investee companies to take these steps?
Yeah, I think that, it will be a dance. Part of it will be coming from the regulators, and a lot of the early push to get companies to be more responsive in this way may start with the regulators. But what we're already seeing, David, is that there's a significant change happening in the banking sector. And we all deal in markets. So I think it's very clear to understand that as the allocation and the access and the cost of capital begins to change for these companies, I think you'll see a lot of the impetus shift from the regulators to the companies themselves.
Yes, there will be a bandwagon, won't there? And there'll be people will say, well, we don't want to get left out of this. I mean, you see it happening already. So we've actually ranged over quite a number of themes. Let's go over to you now then, Stefan. What strikes you from the poll that we had just now? What strikes you from the overall findings? Do you agree with the idea that we're going to have to get ready for the low interest rate scenario to carry on, or could something affect that outlook? Stefan.
Hi, David, and thanks for having me on.
You're looking very reflective. I like this. You're thinking great thoughts in British Columbia, clearly.
Well, we'll see. We'll see. I think the challenge here is it's a bit of what Torbjörn said beforehand, which is that this has been a journey, not an event, right? And I think when we were having the prep session for this discussion, we were talking about lower for longer as a label and how relevant it was, because at some stage we have been lower for long enough that it sort of does become permanent, right? And I think the lower for longer label was invented around 2008 from memory. And it's interesting to see, for me, the wide disparity when you talk to people about how soon normalcy, whatever that is, might start. 2 years versus 4 years versus 10 years is quite a big difference, right? And my own perspective on this is that it's not just about the demographics. I think the demographic can be important, but I think they're not a great predictor, right, of expected returns. It's also about who owns what assets. You know, we have a world where a lot of assets need to be transferred from older generations to younger generations, and at what price? That's a really interesting question for us to think about. And we also have a world where there's immense digitization, which keeps supply curves moving out. And now we have a world where we've got a big domestic demand fall because of COVID. So from my perspective, I struggle to see a world of inflation rebounding anytime soon. And I know we've spoken about labour market difficulties, but by and large, for the last 20 years, we've been operating with a labour market pretty close to full, and we still haven't been able to generate much in the way of inflation. And that can be because of all sorts of things about globalization, about the lack of unionization, for instance, in the workforce that's also been changing. But in general, it's been hard to see what's going to be a real substantial enough catalyst to create economy-wide inflation. And I think that's still the challenge for the inflationists, if you like, out there, who are looking for inflation either to rescue away debt levels or to increase wages for different parts of the economy. So my own perspective on this is that we have to get used to a world of zero or very low rates, possibly even negative rates. You know, I don't think we can discount the chance that we have entire yield curves below zero for a very long time.
Does this mean that this tendency, which we've outlined in the report, which is that the amounts being entrusted to fixed income falls in the average pension fund, does that mean that's going to continue almost inevitably?
So I think that's a governance question. So I think, like for instance, if we think about the equity chart that was shown earlier on, there was, you know, the Australian funds tend to prefer lots of public equities, and Canadian funds and North American funds prefer, and American funds prefer lots of private equity. Well, in my mind, there's a bit of governance going on there. In Australia, you've got this ability to switch between funds quickly, right? So funds need to have a lot more liquidity in Australia than they do in North America in defined benefit schemes. So I think there's a bit of governance that goes around that's underlying some of these, underlies some of the rationale for different asset allocation decisions. But I do think it's going to be very hard. So there are some countries and some regulatory systems that say that will allow for fixed income allocations because of the way the regulations work, particularly in Europe, right, where matching is required, a lot of pension systems and so forth. But I think in general, it's the question about certainly owning government bonds for anything other than liquidity purposes will come under some duress.
Yes, perhaps we could carry on that line of thought to Sally, because it seems from all the findings of the report, plus this general feeling about interest rates remaining at rock bottom for a long time, pension funds are going to have to go into more risky areas, almost inevitably, because as we've heard from Pierre, the actual real rate of return, that hasn't changed what people have got in their mind. You've still got to make money on the pension funds, and you've also got demographics at your back because there are going to be lots of retirees. So isn't that a contradiction, Sally? The pension funds are supposed to be as safe as the Rock of Gibraltar, and yet you're being forced to go into more risky areas where you may well lose money. How do you square that circle, Sally?
Well, I think the important thing, certainly in the UK, in the private side, is thinking about an integrated risk management approach, which is basically saying you've got certain funding risks, which might include interest rates, longevity, inflation. You've got certain market investment risks, which might include equity prices or some of the other issues around there in the market. But also you've got to think about your sponsor, because these things are all linked together. And if you forget that, who's paying the money and what's their risk appetite, you're missing the point, because these trusts were all set up for a purpose. So thinking about all of those things together is absolutely vitally important. Now, if you regard actually that public sector finances, those that are paying the funding amounts, are there for the long term and are secure for the long term, then that means you can afford to take risk if it means it's going to be better financially for that organization. It's going to save them costs, and it's going to make the whole system more viable longer term. But the important thing is not to throw your money away. And I think one of the things that the public sector funds have been thinking about more in the UK is whether the way that the private sector in the UK batten down the risks, doing that through lots of swaps and derivatives contracts and what we call LDI approaches, whether that's a cost-effective way of doing it or whether doing it through cash flow driven investments, so longer alternative investments, as you called them earlier, David, with predictable cash flows, whether those might be a better matching asset. And actually that might represent a better solution all round. It's not necessarily more risky if it's generating the right cash.
I mean, thank you. Let's explore that, because in fact there's a question come in from the audience, basically this question could have been put at any time over the last 5 years, but I'd like to put this to you, Torbjörn. The questioner says that pension funds are being driven into the so-called alternative area, but in fact prices of real assets are being driven up all the time by excess competition. And so there's clearly a risk that one is buying into an already somewhat overstretched market. And the question simply says, how are you going to make money from these so-called real assets if the prices are being bid up? And then one can add to that, of course, that even assets which are thought of as safe. I mean, let's take investment in airports, for example, which a lot of sovereign funds piled into financing things like Heathrow Airport. That has not been so safe, has it, because of a pandemic? So aren't people, Torbjörn, inevitably going to make lots of losses on assets in the so-called real economy area? And how do you safeguard against that? And how do you tell the angry pensioners that you may not have the money to pay their pensions as a result of developments like that?
No, well, first of all, Sally is absolutely right in that you have your mission as a pension fund, you have your long-term return targets. You might have a very specific liability side that you need to adjust to your portfolio's risk and your portfolio's duration and so on. I think you have to realize that expected returns on all assets are lower and much lower today compared to a decade ago, or even easier compared to 2 decades ago. So your expected return on your risky assets, your private assets, alternative assets, your listed equity, and your bond portfolio is about an equal amount lower. Say it's 2% lower than 10 years ago and 3% lower than 20 years ago. And that goes for all assets. Are there particularly expensive pockets of the market right now which you should avoid? I'm sure there is, but that's more a cyclical thing, I think. Asset markets are prone to be cyclical. They are either very cheap after a very volatile period, or rather expensive after having recovered from a volatile period, and we are probably at that point at the moment where assets are relatively expensive, and this recovery we have seen since March is of course exceptional. We haven't seen anything like it in history in terms of speed and magnitude.
Well, we might just add on a question to you there, Torbjörn, before going over to Sandy. The latest spurt we've seen in the last couple of weeks, because of the vaccine news, has been actually the biggest change in the style way of looking at stock markets for about 20 years in terms of the defensive stocks that have been very much in the ascendancy have all been now driven themselves onto the defensive, and the classic growth stocks that have been put in the shade, I'm not talking about the tech stocks, the other areas of that area have been now very much back in line and very much in buoyant. I mean, is this something, just looking at the performance of the last 2 weeks, is this something that you think yourself is a bit of a shot in the pan, is something that will just be temporary, or has this vaccine news, do you think, completely changed the fundamentals of the stock market because people are thinking now about a return to something like normal by spring next year?
Well, it is a rotation within the equity market. It has done some good on the overall equity market, but these rotations go on and are very cyclical in nature as well. I think so far the market this year has been sort of caught in the headlight all along. So it has not been long term at any point this year in its actions. I think the market is still very much caught in the headlight.
Yeah, well, I think we have to excuse the market for being caught in the headlights, really. Sandy, let's go back to you now, away from these temporary blips in market developments, because we may come back here again in a month and things may be different again. But could you just go back again into this structural change in the industry when you start looking at the ESG that you were talking about before? If you talk to some of the big public funds, like, say, CalPERS, they are part of a very big movement around the world under which they are enlisting with other funds, both public and private, to bring about a change in behavior by the very large corporates that themselves are responsible for a good part of the world emissions. Do you think this kind of partnership between the pension funds, from your vantage point, Sandy, at Citi, do you think this partnership between pension funds, whether in the interest of ESG or anything else, co-investment, for example, is now here to stay? They say there's safety in numbers. Let's band together for various reasons.
I think that there's absolute value in that. And I think that the long-term investment horizon and the sense of fiduciary duty and the intergenerational requirements of pensions position them very well to be the advocates of long-term investing orthodoxy, right? And I think that a lot of what has happened in recent years has become more and more short-term in the market. And as large asset owners, it makes sense that this is an area where pensions would band together, because there is a common sense of what needs to occur. But I don't think it's going to be just pensions, right? I think that as these key performance indicators become clearer and people understand what it is they want to measure in the portfolios, we're already beginning to see the large investment managers also partnering with corporations to think about how to structure new types of bond contracts that will actually embed certain key performance indicators into the instrument itself, right? And so that too could help to really forge this partnership. And it could be a three-way partnership where the pensions are engaged as well in really understanding what is it we want to collectively see happen to improve the long-term valuation prospects of these companies. And can we use the financial instruments to actually direct money in that way? And I think that just to comment on some of the conversation that we've been having, I think that there's some other key structural changes that are happening that are going to help with the allocation challenges that we've been discussing. My team calls this the decomposition of outperformance, right? And what we are talking about is that really since the mid-1990s and the emergence of Fama and French, we have really been identifying the factors that are driving the performance in investment portfolios. And because of advances in technology and the ability to actually be monitoring and running these portfolios to understand these factors in real time, we're able to track those factors and understand at all levels, where are the returns in the portfolio originating from? And as we're able to do that, when we look at those equity numbers, and increasingly as we look at those bond numbers in terms of exposure, in terms of allocations, you have to look inside those numbers and understand where is the allocation going. And increasingly, those allocations, a big chunk of those allocations are going to passive investment funds that hold a huge number of securities that diversify a lot of the risk and add the liquidity, particularly if you're using the ETF structure to be able to move in and out of those positions very quickly. And we're even starting to see more use cases where we're seeing short-term bond duration ETFs being used to manage cash in a portfolio.
Well, that's a really interesting development, isn't it? I mean, the massive software that's involved in that, I think, is of mind-boggling proportions. We'll come back to that in a moment. I mean, the ETFs and so on, and maybe the death of activist investors. Some people are talking about that. But first of all, Stefan, let's have your view about the grouping. Is this all bad news for the investment managers, the classic investment managers, if the large funds are going to be grouping together far more? Is it, in some ways, they're calling time also for private equity on the classic LP-GP structure if individual funds are disintermediating the managers? Is that happening, Stefan? Is that a trend that you can see gaining pace?
It's a trend that I've heard that is ongoing practically my whole career, is perhaps what I'd say. So it's interesting we never get there, and I think that's because the underlying dynamics of the market are always changing. Right. If we think linearly about trends, then you can envisage a world where, if everyone keeps turning themselves into an asset owner, a la the Canadian model or the Australian model, then eventually there'll be just a clump of asset owners and no need for asset managers in the middle. But that doesn't really happen, right? What happens is that we dream up different ways of researching or analyzing. We dream up different ways of investing. We dream up different ways of owning assets, and also investment preferences change, right? So we were talking before about fixed income allocations changing. Well, that's been a massive change in how people need to think about risks, and how they think about their objectives, and how they think about building portfolios. So the world, in my mind, the investment world is too dynamic for that outcome.
And how does it work with your fund? Can you be specific about British Columbia, the extent to which you have taken some of the risk management, say, in-house by, as you say, becoming an asset owner in, say, private equity rather than asset manager? Have you basically taken over a lot of additional personnel to carry out those.
Yeah, so if I could talk about how
jobs.
we've done this, what we've done is that, so the challenge you have as an asset owner is how do you make sure you get access to the full complement of opportunities out there? So we can't go out and have 50 offices around the world to make sure we get all the right deals right around the world. So we do have to rely on partnerships, whether that's in private equity or in infrastructure, or in private credit, right? So we need to have a partnership model where we have key personnel internally who are making the key decisions, also running portfolios internally, but still relying on partnerships externally in order to make sure we get the right breadth of opportunities, right?
And how do you actually select those partners? Do they select you, or are they just the last person you met at a conference, to the extent you're going to conferences, or is it all part of some strategic plan that you worked out?
I think it's got to be part of a plan that fits in with the idea of how you meet your overall objectives, right? So there also got to be investment preferences in there. So if you have a preference for business to business investments rather than business to client investments, retail investments, that will change the sort of partners you do look for in the industry. That's quite true. But I'd also add one thing. You mentioned about what else that you need to insource, and I think you need to insource and build really good what I call strategic risk systems. And these are the systems that allow you to add up and think about all of the challenges and all of your risks at a total portfolio level, and say, right, what are the key risks apart from VaR and apart from traditional risks that we need to be worried about? What are the things that are going to tip us over in difficult times? And that tends to be, going back to the question you raised to Torbjörn about what to own and how do we own long-term assets, that's ultimately about liquidity. It's ultimately about making sure that we're not short of liquidity when times are tough, that we can hold on to the assets we think we want to hold on for the long term, that we're not forced sellers of assets and therefore crystallizing losses. And in order to do that, you need to make sure you've got enough liquidity when the times go bad. And you need to make those liquidity measures, or those dry powder measures, or those asset allocation measures, whatever you want to call those measures, they need to be really clear, and they need to be management measures that are used right at the top of the organization.
Well, that's a very interesting point. I'm sure many people in the audience will sympathize with that. This brings me on to a polling question that we have prepared for the audience again. While we're just getting that up on the screen, also those of you around the world who are listening to this, please do put in your question. I've got quite a nice batch of questions now. I'm going to ask now regarding the world central banks. Now, where there has been a lot of intervention by central banks in the last 9 months, and this has actually prevented the system from fouling up and seizing up, and has prevented that kind of liquidity moment that Stefan has been talking about. Because if financial markets did seize up, you could well find yourself pension funds having to sell assets into a losing market. The question to the audience is this massive amount of quantitative easing by the world central banks good or bad for the pension fund industry? And we're talking about whether it's net good or net bad, because clearly it may be a bit of both. And I think we're taking as our time horizon here, say, a couple of years. Is it good or bad or neither? Because you could say it leads to a lot of distortions as well that makes your job actually more difficult. Also, Pierre Ortlieb, although he doesn't know this yet, you can maybe comment on this, Pierre, after the findings come out in a minute or so. And so, Pierre, when the final results appear on your screen, I'm going to ask you, Pierre, to comment on this. First of all, let's just have a question from the audience. And if I can maybe put this question, first of all, to you, Sally. The question says, has the pandemic generated what the questioner calls a bucket of themes that pension funds will look to capitalize upon in coming decades, digitalization being one obvious beneficiary? So, Sally, tell us about your pet themes now, please.
Well, if you really want me to tell you about my biggest pet theme is long-term care for the elderly. So we're pension funds, right? And we care about the quality of our retirees' life. And yet this pandemic has generated an impetus, I think, to a theme that was there, and that all of us, I'm an actuary, I know the demographics, it's not working in our favor. We've got an unsustainable old age care system, and I don't think any of the countries represented around this table have cracked this. So my theme would be what can and should, on the S part of ESG, pension fund investors be doing to make sure that actually not only can we pay the pensions, but the pensions are going to be spent on things.
Okay, well that's very good. Let's go quickly to everybody. You're not allowed to mention ESG because we've done that one already. So Torbjørn, what is your theme of the moment generated by the pandemic?
Speaking silence. No, I think as we pointed to before, starting with asset price valuation, I don't think there's any bargains that pop out from the pandemic. I think the most challenging thing for us as a significant property owner is how will the use of those properties change. Eventually, I hope we will have a good plan for that and be able to adjust our property.
You're talking about commercial here, clearly, not residential.
Yes, we are. Yes.
Okay, Sandy, theme of the moment?
I think by far the theme of the moment has to be the real huge realization of how risks in a systemic risk event cascade in unexpected directions. And therefore how really kind of decomposing something like climate change into a geographic risk or a sector risk doesn't really work, because you don't know where those risks are going to what other sectors are going to start to be impacted as part of the cascade. And so what I think the biggest theme is going to be is an increased thinking about supply and demand chains. And an increased sensitivity to not just the company's valuation itself, but what is the ecosystem that the company is operating.
Well, that's a very good answer. And I'm sure that you've got an algorithm to help us on that as well. And just before Pierre will comment magisterially on the findings, Stefan, your theme that you've learnt about from the pandemic.
For me, I think it would be technology. I think if you'd told the panel in January of this year that there would be a global health pandemic that would have shut down vast swathes of the economy, stopped airlines, halted the travel industry, forced enormous government intervention, and really changed the way in which we have to interact and got stuff delivered, and you would have said, yeah, sure, call me from the cave. And I think technology saved us. And I think what this has shown is just the sheer force of technology and being able to hold society together. And it's just overwhelming ability to rescue us.
Yes, well, of course, there may be another pandemic next year, and then we might need another bout of technology.
Yes, that's true. That's true. That's
who can tell?
Very positive outlook there, David.
Yeah. Let's go over now to Professor Ortlieb. Pierre, can you tell us what you deduce from these findings? It says most people think that quantitative easing is bad for the pension fund industry. Did you expect that, Pierre?
I mean, it depends on the time horizon over which you look at this, right? I mean, I'm sure most pension funds are quite happy that large-scale asset purchases help to significantly dampen market turmoil in markets.
So you think they're being economical with the truth, do you? That's what you're saying.
They're being a little disingenuous here, perhaps. I mean, look, if the U.S. Treasury market is malfunctioning and the only thing that can help it sort of smooth out a difficult period is giant repurchase agreement by the Fed and QE, then that's obviously a good thing for the pension fund industry. In the longer term, I mean, I'm not sure about the balance between QE and sort of global savings dynamics that are driven by domestic policy and how those are causally interlinked. And I mean, the implication of that for the pension fund industry is obviously more mixed, right? So I think it depends on A, the time horizon, and then B, you know, on things like where you're looking at it from, which jurisdiction. I mean, obviously, yeah. I mean, QE is more. I think we should do a better job of provincializing QE sometimes and thinking of it as a more local phenomenon. Although obviously that's changed a little bit with the pandemic. I mean, it really.
Thank you for that. I think it will repay more attention. That's what you're saying, and it's a bit like when Chow En Lai was supposed to have been asked about the French Revolution and said it's too early to say. So we probably will need to revisit that one. So, before we go to the next question from the audience, does anybody from the panel have any strong views about the audience findings that 39% thought it was bad over what time horizon we don't know, and only 29% thought it was good? Anybody? Sally, do you have a view on that? What would you have said?
I think you're absolutely right. It's about the time horizon, and most pension funds will be thinking longer than just, well, thank God my assets didn't crash this week, or this month, or this year, and will know that they will have to face up to whatever the consequences are.
Yes, because you can certainly see it cuts both ways. It's be a good subject for discussion, maybe in next year's global pensions report, where I definitely think we will have to go more into the question of risk than we've done this year. Now I've got another question from the audience. Perhaps I can put this one to you, Torbjørn, and it's something which maybe strikes to the heart of the Scandinavian approach to economic management. It says, how does pension funds' role in rescuing economic sectors, for instance, in individual fields of industry or individual regions, how does this role of pension funds in the kind of rescue function conflict possibly with the fiduciary duty of delivering returns? It clearly implies that pension funds do have a role in sometimes in rescuing or propping up regions, but unfortunately, and they certainly do in different parts of the world. How would you describe your answer, Torbjørn, to that question?
Well, to be able to fulfill your fiduciary duties, hopefully you are free to do the best possible investments and not encouraged by your, say, politicians to do those investments. I'm hesitating a bit because so far most crises have been very good investment opportunities. So where you had the most severe crisis, it's been good to put your money to work there. But of course, it should be based on analysis, not politics.
I thought you were going to say that in order to serve your fiduciary duties, you do need to actually have people who are going out to work and paying into the pension funds. And therefore, you might think that shoring up regions or sectors might, in the long term, have a beneficial impact on the pension fund industry. But does anybody else have a view on that? Stefan, do you have a view on that? In Canada, I'm not sure whether it happens with British Columbia, but I certainly know the Quebec pension fund, the Caisse, clearly has a big role in the Quebec local economy. I would imagine that you do as well. So could you comment on that question, please, Stefan?
To be perfectly clear, our mandate is all about financial outcomes in terms of ensuring that the investment returns are what our clients, our pension insurance clients, need. So we have no obligation to focus on any specific economy, Canadian, British Columbian, or Bahamian. So there's no emphasis there. I think though that's an interesting challenge, right? And you said earlier on when you're asking Sandra about ESG, and there was this hint about exclusion discussion. It's very hard for pension funds to do this without clear direction from their trustees and their stakeholders. right? So I think it's an interesting ground to be on, to say that you should be supporting some sectors or not, or excluding some sectors or not. I think it's a very, that's a different, they're related, these questions, in my mind.
Yeah, well, maybe it's something we can come on to you with, Sandy, because in terms of exclusion, if we're just building a bridge between what I asked earlier about exclusion and this question, which is about diverting money into certain areas, so it's kind of positive exclusion, if you like, or it's doing the opposite of exclusion. Do you see this as a trend, Sandy, that which the questioner is asking? And then more generally about exclusion, as Stefan says, I don't think you could do this just as a manager without having some direction from the pension fund trustees. There could be a tendency, broad brush, for instance, would a pension fund say, I'm not going to invest in airlines because they, by definition, burn fossil fuels? It could lead to slightly ludicrous outcomes, because after all, undoubtedly, airlines do serve a social purpose, but they're not just flying business people over to Milan for a day's work in the coal face. I mean, how would you react generally and specifically, please, Sandy, to that question?
Well, I think you just illustrated the exact problem that we are encountering with this use of blended ESG scoring today, right? Because we're excluding companies because they have a poor aspect to their score, and because we don't have any direct lever to actually measure the company relative to that specific indicator, we're forced to use these very blunt force measures. And as a result, all of this exclusion that's happening in the pension portfolios is really doing nothing more than addressing the headline risk of the long-term value of these companies. And so I firmly believe that instead of exclusion, as we can tie the capital to the measurement of behavior, a lot of the companies that are being excluded today in the portfolios are probably going to become some of the most sought after investment targets, because they have the potential to have the most change and to change, therefore, their underlying long-term valuation the most, right? And so I think we're going to move completely 180 degrees away from exclusion. And we are going to increasingly get better about tying the capital to both financial returns and non-financial KPI improvements. And that will be the real, I think, blend that we need to really allow ESG strategies and pension portfolios to really become effective at fulfilling their aims, right? And just one point on the fiduciary duty. A lot has come out because of the Department of Labor having put out these rules in the US saying that, they were excluding corporate pensions from having an ability to invest in investments that were being done for any social purpose. And there's been a lot of controversy about that. And I just want to clarify for people that there's a very specific set of circumstances as to why that is the case for corporate pensions under the ERISA rules in the US. And it has to do with the US government being the backstop to those companies in their pension.
I'm sorry, I didn't understand that. How do they define social purposes? What does that mean?
Anything that, anything that has an exclusionary aspect to it is really under scrutiny now by anyone in a corporate pension plan. So I think that to this exact point about, is the current approach to ESG actually counterproductive in some aspects? I think that, the answer is clearly yes, but the tools that can make it more productive are on the horizon. And I think that we will be able to see much better strategies going forward.
I mean, it is an interesting point, because I noticed that yesterday the British Prime Minister Boris Johnson put forward this idea of some kind of green deal for Britain. And of course, the promoting nuclear power is all part of that, because in a certain number of countries, nuclear power is thought of as being very helpful. It reduces carbon emissions. If I was to put that forward in Germany, that would not go down very well, because their nuclear power is thought of as being supremely ungreen. So does anybody on the panel have a view about nuclear? I mean, where that should fit into an ESG portfolio? I mean, Sandy, you were talking about all this beforehand. Do you have a quick view about is nuclear green or not green?
I don't feel like I am qualified enough to talk about a specific sector in the industry. I will defer to my much more
Torbjörn, Sweden's got a certain amount of interest in this. What is your view? It's a completely random question to you. I've just put this to you, Torbjörn, because you look rather professorial, and therefore you might well have a good answer to this.
Well, AP3 does not exclude nuclear. I'm part of the WWF investment committee here in Stockholm for the Swedish WWF. We do not exclude nuclear, but it's a very, very hot topic, in particular in WWF terms. No, I really enjoyed Sandra's comment. It's, to move forward and see this as a transition and take responsibility for that. I think that's super important. I mean, what does it help to divest from a sector? I don't think it's due. Eventually, you have to divest from some companies that you don't like and they don't listen to your opinions. Should you divest from certain sectors? Yes, sectors that they cannot come back, you should probably divest from, at least from a financial perspective. But looking at the total energy sector, we are super dependent on that. So,
well, also I think the word you use is transition, and I think this is where the G in the ESG is very important, because if you've got a governance system that allows stakeholders to talk to companies and find out what they're doing in their transitional arrangements, these transitions may take 50 years, but you've got to start somewhere, and therefore it's not it's not just the starting point and the end point, it's the process that you need to look at, isn't it? And that's what these ESG processes really need to concentrate on, I think, in looking at the whole overall path. We're getting towards the final 15 minutes. I want to round off also on a question that I hope will help us put together the GPP for next year. So I want to reserve a little bit of time for that. And Pierre, I'm sure you'll be listening particularly to that point. But I've got a question from the audience, in fact, a couple of questions. One is about Asia, and perhaps I'll put that to you, Stefan, since from the west coast of Canada, you're looking towards Asia. Could you tell us, please, Stefan, how does COVID, how has that affected your views about Asia, the pandemic, and the relatively good performance of Asia macroeconomically? How do you fit Asia into your investment portfolio in the medium and longer term, either positively or negatively?
Well, so right now, I think on COVID, I really do think it's too early to tell what the impact is, right? So, I mean, we have a global portfolio. Regardless of the asset class, really, I mean, we're at different stages of globalizing it. You could argue, but certainly in global equities and private equity and infra, we have a global portfolio. We in terms of the impact of COVID on Asia, I'm not so sure it will be much different. I think if I was to try to categorize impacts on economies, I'd look at how strong their underlying public health systems were. And in that sense, you can get quite different outcomes across Asia. You know, Singapore, for instance, itself is fantastic. The ability to distribute vaccines once available, which will be a lot about how urban or how non-urban economies are. And then I think once vaccines are out, the ability to re-engage in the economy, the ability to get back onto the global trade bandwagon, the ability to reset trade flows, which I think is really important for a lot of Asia, right? We think about Asia as an export powerhouse. So those would be the three questions I'd have in my mind as we thought about this for the next 12 months.
And I suppose if you're thinking about China, it's not just the underlying health system, it is the overall system. The whole track and trace in China works very well because you do have a totalitarian system. That's the point, with a lot of control. So it's not simply the underlying quality of doctors and nurses. It is something quite systemic. And then you just have to accept that China has worked pretty well in the last 3 or 4 months, because they've got a total recall of what the population does, and they know what the population does. So one can't beat about the bush. That is quite helpful. Sally, do you have a view on Asia?
I think that one of the most interesting things we're tracking right now is that, because of COVID, I think that a lot of the tension between US and China has become exacerbated. And probably we have moved years forward in terms of the degree of hostility that's starting to emerge between the US and China.
I hope not too many years forward, otherwise we'll be getting to the end of the world, won't we? We don't want that.
Not too many years.
Yeah.
But you do see the SEC is considering rules to delist Chinese companies. You've seen all of the homecoming IPOs, and yet you've also seen the issues that this brings up for the international market, with them having pulled the Alibaba IPO 2 days before it was due to go forward, right? And so, while we continue to see Asia, and I think Asia's role has been strengthened because of its responses to COVID and its ability to get its economies back online in a much more effective way than many of the countries in the West, I think that it also has highlighted some of the issues that come with having those kinds of governments that do have the ability to exert kind of capricious control over them.
That's a good point. I mean, we don't want to get too waylaid by the ant issue, especially 10 minutes from the end. But I thought that was a very positive aspect, actually, because it shows that the Chinese are slowly waking up to the real world. There were real conflicts of interest in that IPO, and it should never have got to the stage, I think, 2 days beforehand. But I think they did the right thing in the end. But maybe somebody else has got a view about Asia in general. Sally, have you got a view for the local authority partnerships about bringing Asia into the UK pension portfolios?
It's certainly already in the kind of global approach that we would use towards equities in the UK. I think because the UK stock market has always, or at least within my working memory, been fairly sector concentrated, it's been really important to diversify out. I think what's interesting is how Asia, where we're talking, the conversations we're having here about social issues, about political issues, and the risks that come with those. So to Sandy's comment earlier about how do you blend all these things together, including the risk perspective, but also the systemic issues. Our current, quarterly performance and latest stock, announcements, is that really ticking the boxes in terms of how we should think about a system and economy that differs very much from ours, and how we
I think it's a very sensible way of looking at it, and from the overall point of view of risk, and the fitting countries and geographies into that rather than starting with the countries and geographies. I think that's the right way.
Yeah.
A question to you, Torbjørn, for the audience, and then I want to go on to the planning for the next year's GPP. So after Torbjørn, I want to ask Pierre very quickly to say what are the plans for next year's GPP, and then I want everybody to help us to produce it. And I'll therefore be asking a question of the audience in inverse order. So I'll start off with Stefan and end with Sally. But first of all, Torbjørn, a question from the audience. What is your view on the use of leverage in pension funds? As the head of strategic asset allocation, I'm sure you think about this, maybe not every day. And also, has COVID, from your point of view of AP3, has that affected your desire or ability to use leverage?
I would love to talk about Asia.
Well, do that as well. I'm not cutting you off. Tell us about Asia, but tell us a bit about leverage as well.
No, sorry. I'll try to make 2 quick answers then.
Yes.
But I can't talk about demographics in every investment committee meeting because it doesn't change much. So.
I bet you do your best, though.
No. I also talk about geopolitics. That changes a bit. So that's my Asia angle in a sense. I think we have. I think that's a new thing for long-term investing. I think we have 3 distinct geographical financial areas. I think we have Asia, Europe, and US. And investors need to think in those terms more. And of course, Canada belongs to Europe in this.
Canada belongs to Europe. You heard it here first.
Yeah. So that's my Asia angle. And the other question was leverage. Well, we go more and more into implicit leverage because we use more and more private assets, and that is property companies, infrastructure, and timberland, and private equity for us. They use more and a lot of leverage. So I think that's the way we make use of free money, if you like.
I see. What, just as a rounding off to you, what is the percentage in AP3 then of these so-called private assets that are not publicly traded? What proportion roughly?
1/4 of the portfolio, roughly.
Yes, I see. So it's a bit above benchmark, isn't it? And that's clearly a very important part of the overall findings of our survey. Pierre, just in 1 minute, are there any plans for GPP 2021? I know we've only finished with the GPP 2020 is just 1 day old. So you've got 364 days to go, but I'm sure you're thinking about this already. Give us an overview.
It really keeps me up at night, David. I do. I mean, I have several kind of things that we want to explore. I mean, Stefan made a great comment earlier, I thought, about how governance shapes asset allocations, and Australian funds having to hold more sort of liquid listed equities. I think that's something that we want to explore further. I mean, in the US, you have these massive funds that hold treasuries that are specifically issued to them. I mean, things like that, those sort of intertwinements, I'm interested in sort of hedging behavior as well, and how pension funds hedge. That's something where the data, I think, is probably available, but it's more challenging to collect. So things like that, and obviously ESG, particularly. I mean, we looked at the corporate governance side this year, so maybe we'll have to look at either the E or the S next year. So things like that, I think, are
okay. Well, that's banking up on the horizon. Now we've got 4 minutes left, so you've got 1 minute each, basically. So starting off with you, Stefan, what apart from the one you mentioned already, which is technology, what do you think we should be looking at as trends which are shaping the industry for the next 12 months?
Oh, next 12 months.
Well, or longer if you like.
Well, I think this I think the trend to more and more liquids is unstoppable, and I think how asset owners generally think about liquidity as a tool as well as a management tool and a decision tool is really important, because it's liquidity management that's allowed the people to have got through the last 12 months without selling assets at losses to be able to successfully avoid crystallizing those losses. And I think the other thing
that's a very important. Thank you. That's an important point. And of course, that does depend also partly on the success or otherwise of the authorities in managing the overall system. This clearly is something that depends on a lot of other people. Sandy, you're not allowed to talk about risk because you talked about that already, and you're not allowed to talk about ESG. So what else would you put into the GPP survey for next year?
One of the things that we talk about a lot and have been tracking very closely is the level of internalization of trading responsibilities that we're seeing from pensions around the world, and how that alters your relationship with external managers and where you most strategically can deploy external managers and where you can most strategically partner with external managers, and what makes the most sense to internalize from a cost and an exposure perspective in terms of your portfolio construction.
Well, that's very good. Thank you. And you've all done really well so far. Sally's got the most difficult part because you're not allowed to mention anything that anybody else has brought up. So, Torbjørn, without mentioning anything that's already been brought up in the discussion, what's a big theme would you think we should be focusing on for the report that Pierre is going to produce 1 year from today? Torbjørn.
I think the global investment dimension, so I already mentioned that one in terms of geopolitics, but I think that one is not going away with the recent US election.
Yes, well, and we will be 1 year into the Biden presidency, so we'll know a bit more, and a resetting of multilateralism, maybe. Sally, you got the last word, but it's the most difficult word because you're not allowed to mention technology, old age, risk, ESG, or anything else that we've mentioned already. So I'm looking towards you. We all are, Sally. Big expectations on you.
So I think I'd say purpose, politics, and regulation. Underneath the behavior that you're seeing is quite a mix of different constraints, different motivations. Unpacking that, understanding that, to me, is the most important thing for other people looking at the report and saying, how should I do different things differently? And the real important one in there is time frame, as we have talked about before. Good.
Well, thank you very much indeed for rounding it off. I think purpose and politics, that's something which pension funds cannot really shy away from. So you've helped us immensely, actually, and I think it's also been helpful, I hope, for the audience, because you've put a lot of purpose into the answering the different questions that I and the audience have put to you. So thank you, Sally and Torbjörn and Sandy and Stefan, for answering these questions. Thank you to the audience. Thank you, everybody, for being part of this. Looking forward to engaging with you as we carry on this journey of exploring global public pensions and their interaction with the rest of the world. And do hope that you'll carry on being successful, managing liquidity, technology, ESG, old age, and all the other things we've been talking about. It's been very useful and stimulating talking to you all. So many thanks to you all. This is David Marsh signing off on behalf of OMFIF and our partners for the Global Pension Fund report for 2020, and look forward to being in touch with you as we get involved in the 2021 report, which will not be all that far away. So all the best to you, and keep managing your funds and your health as well as possible. All the best to you. Goodbye.
Thank you. Bye.
Bye. Thank you.